Hello everyone. Now let's start with our module 5, that is valuation of bonds. In the first lecture of this particular module, we are going to talk about the meaning of bonds, the types of bonds and the risk associated with bonds and advantages and disadvantages of bonds. So what is a bond? Bond is basically a fixed income security which is issued by government, corporate or any other entities who want to raise capital from the market, or we can say want to raise capital from the public. So, bond represents a security issued in connection with borrowing arrangement. So, we are focusing on borrowing the money from the public, so that the government, the corporate bodies or any other entity who issued a bond can do a particular project or conduct a particular type of activity with the help of that fund. It can also be known as IOU. IOU, if we expand this word IOU. So, IOU means I owe certain amount of money that will be refunded to you after a period of time. So, if the government or the corporations are taking money from the public, they issue a certificate to the bond holder that they owe the money, and after a period of time they will refund the money to the public along with the payment of interest. The bond obligates the issuer to make specified payment, that is the interest and the principal amount. So, bond holder gets the interest and principal at the time of maturity, or he can get the interest amount regularly or semi-annually, that is regularly means semi-annually as well as a yearly basis, and the principal amount will be refunded at the time of maturity period. The bond can be described in terms of par value, coupon rate and maturity date, which we are going to explain in the next slide. In other words, bond indenture is a contract between the issuer and the bondholder. Issuer can be the government, corporation or any other public sector units who issue a bond to the public, and that person will become a bondholder. Through with the help of that, the government or any other public sector body gets some money from the public. So, it is issued at par value, having a coupon rate and having a fixed maturity period. Everything in the bond certificate is mentioned. What is the coupon rate, what is the maturity period, at after how many years it will be matured, and what is the par value, everything is mentioned in the certificate. Now, what is the par value? The value stated on the face of the bond is termed as the par value. It represents the amount the issuer promises to pay at the time of maturity. Suppose I have taken an example, an issuer may sell a bond at a par value of 1000. So, after a period of 10 years, he is going to refund 1000 rupees to the bond holder. What is the coupon rate? Coupon rate is the interest payable on the bond amount. The maturity date is mentioned, its number of years for which the bond has been issued in the public. So, in this example, if we consider an issuer may sell a bond at a par value of 1000 rupees. So, it has to be mentioned, this is the par value. Coupon rate is 6% paid semi-annually. So, what is the coupon rate? 6% paid semi-annually, and maturity period is 10 years. So, we have all the three things. We have par value, that is 1000 rupees, we have coupon rate, that is 6%, and we have maturity period, that is 10 years. So, in a particular bond certificate or whatever instrument, if the particular government, public sector undertaking or any other government institution or companies are issuing, they have to mention these three things in the bond document. Now, coming to what are the different types of bond. In this figure, we can easily understand that there are majorly two bonds, that is government sector bond and another one is corporate sector bonds. So, there are two categories, government and corporate. So, if we are talking about government bonds, that can be issued by central government, state government or any other government related agencies. They can issue the bonds for a period of time and they basically pay semi-annually interest rate. Corporate bonds has different categories which I am going to explain in coming slides. So, first, what is government bond? As I already mentioned, a government bond is issued by the government bodies. Suppose it is a central government bond, it is issued by Reserve Bank of India on behalf of Government of India, and it can be ranged from medium to long term. These government sector bonds or government bonds are basically known as gilt-edged securities or G-Sec bonds and issued in the interest of public to raise the fund from the public. So, these particular bonds can be issued by state government, as I already mentioned, as well as the government agencies that can be owned by state or that can be owned by the central, but they basically pay interest in semi-annual basis. So, it can be issued by the central government, it can be issued by state government, and it can be issued by the government agencies. All these three bonds are basically issued by RBI on behalf of central government, on behalf of state government or government agencies, and they basically pay semi-annual interest rates. Next come the corporate bonds. Other than government, companies also can raise these funds from the public. In India, it is most properly known as debentures, but in case of foreign country, it is mainly known as corporate bonds. Since in India, bond market is not so developed, so it is mainly known as debentures. So, companies like governments borrow money by issuing bonds called corporate bonds. They can also be known as corporate debentures. Internationally, a secured corporate debt instrument is called corporate bonds. That means it is secured against any particular asset of the company. So, the company whoever is issuing a corporate bond, they should have certain amount of collateral against which the bonds have been issued. Whereas unsecured corporate instrument is termed as corporate debentures. In India, corporate debt instruments have traditionally been referred as debentures, although typically they are secured. So, we can identify the difference between international bonds and Government of India bonds. In India, if the corporates are issuing the bonds, it can be named as debentures and it is secured. In international context, if the corporate bonds are issued, they are secured and they are termed as corporate bonds. If they are unsecured, in that case they become debentures. But in India, corporate bonds are also interchangeably termed as debentures and they are highly secured in financial instrument. Now, coming to different types of corporate bonds. The first bond is straight bond, that is also known as plain vanilla bonds. It is most popular type of bond and it pays a fixed periodic, basically the semi-annual coupon over a life and returns the principal at the time of maturity. It is simple bond. There is no rules and regulation related to the or particular inherent inequality related to this particular bond. Whatever the basic term of bond is explained, this particular straight bond is related to that. The simple bond which has a coupon rate, which has a maturity period and it is issued as a par value. The regulations related to bond whichever is followed in India are applied on these particular bonds. Next one is zero coupon bond. As the name suggests, the zero coupon bond does not carry any regular interest payment. Like straight bonds, they have regular interest payment basically in semi-annual form, but in case of zero coupon bond, there is no interest payment. They are issued basically at steep discount over its face value. Suppose its face value is 1000, it may be issued at 700 rupees and the 1000 rupees is paid at the time of maturity. Floating rate bonds pay an interest rate that is linked to the benchmark rate. Benchmark rate can be the treasury bill interest rate. So, at the time of maturity, whatever is the interest rate, they paid according to that. So, there is no fixed interest rate guaranteed in case of floating rate bonds. It may be higher, it may be lower depending upon the time, of maturity. Whatever is the interest rate, it is paid accordingly. So, for example, in 1993, State Bank of India came out with the first ever issue of floating interest rate bonds in India. It issued 5,001,000 rupees unsecured redeemable subordinated floating interest rate bonds carrying an interest at rupees 3% per annum over the maximum term deposit rate. So, whatever is the term deposit rate at the time of maturity, the bank is going to pay that amount to the bond holders. Next comes the bond with embedded options. Embedded options means in this type of bonds there are certain options available to bond holders as well as the bond issuers. They can use that options at the time of maturity or before the time of maturity. So, what are these types of bonds? So, bonds have options embedded, they are basically convertible bonds. Convertible bonds, in this case the bond holder has a right or option to convert these bonds into equity shares. So, if company issued a convertible bonds, the bond holder has a right to convert it, or they can go for claim at maturity. So, it depends upon the bond holder. So, either they can convert the bond into equity share or they can claim the money at the time of maturity. Then second one is callable bonds. Callable bonds are basically, it gives right to the issuer that they can redeem the bond before the maturity. Although this is a risky instrument for bond holders, but it is a good instrument for the issuer. Puttable bonds give the investor the right to put the or redeem the bond before the period of maturity, depending upon following certain terms and conditions issued by the borrower. Next one is commodity linked bond. Commodity linked bond means bonds which are linked to a particular commodity against which the bond has been issued. So, in this particular example, you can say in June 1986, Standard Oil Corporation issued a 0 coupon notes that would mature in 1992. The payoff from each note is defined $1,000 plus 200, that this 200 is depending upon what price per barrel of oil in dollars minus $25. So, they are going to give 1000 plus 200 rupees. The second term of payoff, however, is subject to floor of 0. So, these are certain terms and conditions associated with that particular bond. So, what in this particular commodity linked bonds, a particular bond is linked or attached to a particular commodity. In this example, a 0 coupon bond is issued, but it is linked to oil prices or oils in dollar. In that situation, if whatever the price of oil is, accordingly the value will fluctuate. Now, coming to this the risk associated with the bonds. So, what are the different types of risk? The risk, interest rate risk is the most common one, inflation risk, real interest rate risk, default risk, call risk, liquidity risk, event risk, sovereign risk, reinvestment risk and foreign exchange risk. These are certain types of risk which are associated with any typical bond that is issued by the borrowers. So, first one is interest rate risk. Interest rate, we already know that interest rate varies time to time, or whatever the central bank's decision, it may vary. So, interest rate tend to vary over time, causing fluctuation in the bond prices. The rise in interest rate will depress the market prices of outstanding bonds, whereas fall in interest rate will push the market prices up. So, interest rate risk, also referred as a market risk, is measured by the percentage change in the value of bond in response to a given interest rate change. It is a function of maturity period of bond and the coupon rate. So, depending upon the time period for which the bond has been issued, if the interest rate fluctuate, the bond prices also fluctuate. Next one is inflation risk. Interest rates are defined in nominal terms, we already know that. This means that they express the rate of exchange between current and future prices. For example, a nominal interest rate is 12% on a 1-year loan, means that 112 is payable a year hence for 100 borrowed today. However, what really matters is the real rate of interest, the rate of exchange between current and future goods and services. If this due to inflation, the price purchasing power of money decreases, in that condition this particular rate is not going to suffice the investor. We are paying 12% interest just because we want to safeguard the investor against the inflation. Next one is real interest rate risk. So, even if no inflation risk, borrowers and lenders are still exposed to the risk of change in real interest rate. Shift in the supply or demand for funds will change the real interest rate. So, if the there is a huge demand of credit from the market, in that case the interest rate increases, and if there is no demand, in that case interest rate decreases. So, this real interest rate depends upon the supply and demand of the credit in the market. Next one is default risk. Default risk is a risk that borrower may not be able to pay the interest at the time of maturity, or they are not able to pay the principal amount at the time of maturity. So, it may happen that at certain point of time interest payable, the amount the investor is going it get at the time of maturity is not payable by the borrower. So, interest may be stopped or maybe the principal amount is stopped. So, that in that situation default risk arises. Call risk. Call risk basically is related to a bond which has a call provision, which we have discussed that in case of embedded options the call risk arises. That gives the issuer to option to redeem the bond before the scheduled maturity, and they do so just to safeguard themselves from the excess amount paid, because if the interest rate is low and if they have sufficient amount with them, they go for the call option and they call back the amount of debentures or corporate bonds from the market and redeem it. But the investors are exposed to this type of risk. Then comes the liquidity risk. Barring some of the popular government securities are not traded actively. Most debt instruments do not seem to have a liquid market. So, in case of bond, as I already mentioned, the bond market in India is not developed and can take to international market, it is in developing phase. So, we face the problem of liquidity. The market for debt is mainly the over the counter market, and much of the activity seems to occur in primary or new issue market. Poor liquidity in debt market, investors face difficulty in trading debt instruments, particularly when the quantity is large. If any investor has purchased a large quantity of bonds or in large multiples, in that situation they face the problem of selling the security in the market, because bond market is not so liquid as compared to equity market. The next one is the event risk. It is occasionally an issuer's ability to meet the interest and principal payment changes dramatically and unexpectedly because of the factors such as natural disaster, regulatory change, takeover or corporate restructuring. These particular events cause the issue of event risk. If certain types of activities took place in the particular company and because of that there is some change in the management policies or some change in the government regulation, they face certain types of problem, and because of that they are unable to pay the interest or the principal amount at the time of maturity, they face this type of event risk. Next one is sovereign risk. Sovereign risk is basically related to foreign investors or the foreign bonds. So, an investor who acquires a bond issued by foreign entity faces sovereign risk. This is a risk that actions of foreign government may cause a default, or even in the absence of default an unfavorable price change. So, in case of foreign bonds, it may happen that the price changes or government policy changes or certain events happen in that particular country, which may cause change in the norms of that particular issued bond. In that situation, the investors or the bondholder faces the sovereign risk. Next one is the reinvestment risk. When bond pays periodic interest, there is a risk that the interest payments may have to be reinvested at a lower interest rate. So, when the bond payers are getting the interest, they need to reinvest that particular amount. This is called the reinvestment risk. Reinvestment risk is greater for bonds with longer maturity and for bonds with higher interest rate, because if the interest rate is high, they need to reinvest it in a proper manner. If they are not able to do that, they may face the losses. Next come the foreign exchange risk. If bond has payments that are dominated in foreign currency, its rupee cash flows are uncertain. In case basically it is related to foreign bonds, because we do not know what is the exchange rate, certain time exchange rate increases, certain times it decreases, and just because of that the particular bondholder faces a foreign risk, foreign exchange risk. The risk that the foreign currency will depreciate in relation to Indian rupee is referred to as a foreign exchange risk. Now coming to advantages of bonds. The advantages and disadvantages of bonds are categorized into two forms, first for the issuers and second for the bond holders. So, in case of issuers, what are the advantages? First is the lower cost of capital as compared to equity shares or any other financial hybrid financial instrument. Bonds are quite low in cost of capital. So, compared to equity, raising funds through bonds has been lower cost of capital since interest payments are usually lower than the returns demanded by the equity shareholders. It is assumed that bonds are less risky as compared to equity, and that is why the interest payment or the cost of capital of issuing a bond is lower as compared to equity share. Since equity shares are most risky instruments, the equity holders demand a higher rate of return. So, in that situation, the rate of return on equity is high and the cost of raising this capital is quite high. While in case of bond, since the risk is quite low, the interest rate paid on these bonds are low as compared to equity, and the cost of capital is also low. Second one is interest payments are tax deductible. So, for corporate issuers, interest paid on bonds are generally tax deductible, reducing the overall cost of debt. This tax benefit does not apply to the equity dividends. Next one is fixed payment obligation. Fixed payment obligation, like bond, provides a predictable obligation in terms of interest payment and principal repayment, making it easier for the issuer to plan and manage the cash flows. Because every year, if the company has issued a bond, they have to pay certain amount of interest out of their profit. So, they know this beforehand, that how much amount of profit is going to be paid every year. Along with this, the payment of maturity the payment of principal amount at the time of maturity is also fixed. So, they can plan accordingly and decide how to collect the money or have a certain amount of reserve, so that they can make the payment easily. No ownership dilution. In case of equity, we issue the shares in the market and we dilute the ownership, but in case of bonds, the ownership rights has not been diluted, because bonds are the debt instruments and the debt holders have no rights in the management or in the ownership of the company. Longer maturity period as compared to other financial instruments, bonds are having a quite longer period, so that the company can think and plan accordingly and have a reserve for that, so that they can pay the interest regularly and pay the principal amount at the time of maturity. Next is flexible structures. Bond can be of any form depending upon the requirement. They can be convertible bond, callable bond, puttable bond, depending upon the requirement of the company. They can issue a different variant of bonds. Now, what are the advantages for the investors? So, the first advantage is predictable income source. So, every investor who is investing in bond, they know that they are going to get a fixed amount of interest at regular basis, or whether it is semi-annual or whether it is annual, but they know this much amount they are going to get after a point of time. So, there is some regularity in income. Then capital preservation, the bonds are quite safe instrument as compared to equity. So, we know the principal amount will be paid at the time of maturity. So, our capital is preserved in case of bonds issue. Lower volatility as compared to equity share, the volatility of bonds are quite low. So, the investors can diversify their portfolio accordingly. If the investor is risk averse in nature, he can go for a bond investment only, and if he is risk neutral, he can combine or mix the proportion accordingly. Diversification benefit, adding bonds to the portfolio can improve the diversification and reduce the overall portfolio risk, as bond prices often have a lower negative correlation to stock, because they are risky instrument. They move according to the market scenario. If the market are volatile, they may face less return, but in case of bonds, they are not related to market, but market is going to affect them, but they are not related because they are issued for a longer period of time. Different risk levels, investor can choose the various risk level based on the bond types, such as government bonds are less risky instrument as compared to the corporate bonds. Then investment grade corporate bonds are moderate risky, and high yield bonds are or higher risk potential as compared to other two categories of bonds. Liquidity, for some bonds it is very difficult, but for some bonds it is easily tradable. So, many government and high quality corporate bonds are actively traded, offering a great degree of liquidity to the investor who need to sell the bond before maturity. So, depending upon the terms or condition of the bond and who is issuing the bond, the investor need to understand the requirements what he has, and then he invests, then it will be feasible for him to sell the bond in the market. Now, coming to the disadvantages, the first disadvantage for the issuer is fixed interest payment. As I mentioned that the cost of capital is low, but a portion of profit is distributed to the bondholders as a form of interest. So, it is a regular payment that the company has to think about, and they have to generate that much revenue so that they can pay the interest regularly. So, bonds require a fixed interest payment which can be burdened during times of low cash flow or economic downturns. This fixed obligation increases the financial risk of the issuer, and there may be chances of default also. Debt obligation, issuing bond increases the debt load of the company, and in the liability side it is be termed as bonds. They are secured against some collaterals or some particular assets. So, it may affect the credit rating of the company also. Restrictive covenants, some bonds comes with restrictive covenants such as maintaining certain financial ratios, limiting additional borrowing and prohibiting certain business activities. These restrictions can limit the issuer's operational flexibility. So, whenever a issuer is issuing bond, they have to look into this particular facts, that what type of regulatory obligations they have to face and how they have to deal with that particular regulatory issues. Repayment obligation, because at the time of maturity they have to pay a lump sum or huge amount to the bondholders, they have to have that particular obligation in mind. If they default, the company's name is got affected. If we can take the example of IL&FS, they made a default and it affected the company badly. So, interest rate risk, if interest rate declines, issuers have to redeem callable bond early, leading to higher cost if need to refinance at less favorable rates. Conversely, if interest rate rise, issuers are locked with paying higher interest rate compared to the prevailing market rate. This particular interest rate risk is applicable at the case of floating bonds, where the interest rate is floating according to the market situation. Then what are the disadvantages for the investors? The first one is lower potential returns, because bonds are going to give a interest rate and interest rates are quite minimal, up to 5%, 6% or 7% depending upon the instrument issued by government or corporate bodies. So, they have limited potential of growth. Interest rate risk, bond risks are sensitive to changes in interest rates. If interest rate rises, bond price falls, and which result in capital losses. So, if it is a liquid bond or it is tradable bond, in this particular case they have to the bondholder has to face the interest rate risk. Inflation risk, bonds may not keep up with the inflation because the rate of interest is quite low, or if the inflation rate is increasing, they cannot keep up with the situation, especially in case of fixed rate bonds. If inflation rises, the real value of the bond decreases, eroding the purchasing power over time and causing loss to the bondholder. Credit risk, corporate bonds carry credit risk, which is a risk of default by the issuer. High yield bonds in particular have higher credit risk, which means there is a chance that investors may not receive the full principal and interest at the time of maturity. If the company makes default, they may lose the money. Then next comes the liquidity risk. Again, it is for some particular categories of bonds. So, not all bonds are highly liquid. If it is a tradable bond, in that case they are highly liquid and they are exposed to this liquidity risk. Callable bonds can be redeemed by the issuer before maturity, which can cause a loss to the particular bondholder, because they will not get interest regularly as they are thinking, and there arises the reinvestment risk also. Next come the reinvestment risk. If bond matures or called early, investors face the risk of reinvesting proceed at lower interest rate and reducing the overall return. So, if there is a callable bond, as I already mentioned, the issuer in that situation will call the bonds if the interest rate is going low, and in that situation the principal amount whatever the bondholder is getting, he need to reinvest at lower interest rate, which may cause loss to the investor. So, with this we come to end of this particular lecture. Thank you.